Welcome back to the podcast, everyone. So, Andreas recently announced a $15 billion raise. In this market, that obviously lands loudly. It sharpens the contrast between scale and scarcity and brings LP conviction, fund size, and venture's core value proposition back into focus. Today, we're talking to Max Bray from Kindred and Juliet Bailin, who's building something new and is also a VP at Kindred. We unpack what LPs are really thinking, how venture as an asset class is evolving, and why fund models are starting to split at the extremes. Max, you wrote a beautiful blog post that prompted us doing this episode. So let's start there. When LPs look at venture today, what part of the value proposition is hardest for them to believe?
I think it's the outcomes, right? It's all driven by the outcomes. I spent a year trying to raise a fund through 2025, basically. And it started feeling there was something off quite early on in the process. And I was coming into this, it was the first time I was trying to raise a fund. So I'd been kind of sheltered from this previously. And it very much started off with a lot of anecdotal stuff of people being like, oh, it's a really tough market out there, which kind of everyone always says, right, outside of 2021. And you don't know how much people mean that and how much to believe it. But when you feel it, I mean, I was doing a first time fund with two guys who built two unicorns as founders. They'd invested in 150 startups as angels. They'd done 20 LP positions. They had incredible numbers on their angel portfolios, like a 13x MOIC, I think, on one of the vintages. And we were struggling to even get second calls. Like, now we made all the mistakes, right? We made every single mistake that you make as a first time manager. We didn't go into it with an anchor. Our thesis could have probably been more refined. There was a lack of, I suppose, like deep venture experience in inverted commas on the team. But still, I think if it had been a 2021, 22 kind of situation, it would have been very different. And I came to realize, I suppose, that there was this very strong sense that many family offices, corporates, anyone who wasn't like a dedicated venture fund of funds, and even a lot of those dedicated venture fund of funds, were moving out of the asset class. It was like a canary in the coal mine that the fundraising numbers were going to drop. And they were moving towards things that had either security or liquidity. And so that was public markets, it was bonds, it was later stage investing. It was obviously a shorter time frame to exit, it was secondaries. It was anything that wasn't early stage venture, to be totally honest. And the only conclusion you can come to on that is a macro environment that's uncertain and scary, combined with an asset class that is taken like 13 years minimum to spit out returns. That, I mean, I was having conversations with LPs looking across the table and going, I wouldn't give me my money. Like, it's just not a great proposition at this point. So I think it's all downstream of returns in that sense.
I want to just maybe decompose some of the things you say, because obviously, so why do fund of funds that are dedicated to venture move out of the market or maybe not deploy as much? Obviously, like, they're dedicated to the strategy, it's all they can really do, so to say. However, they're raising money somewhere as well. And the fact of the matter is we're all raising from people that are highly impacted by cycles. And if there's anything that any sophisticated LP would know, it is venture, you cannot time it. You got to stick in it. You got to believe in the asset class. You got to just continue allocating. And for that reason, I think that there's a bunch of knock-on effects that you described as being central to the problem of venture as an asset class. And I think what's important to say is it's not about the return profile. It's not about venture not working. It's about the fact that we still rely too much on LPs that do not fully understand the asset class and the importance of investing through cycles. Do you agree, Juliet? Am I being correct here?
I mean, the point on investing through cycles is spot on, right? Stepstone has amazing data about this that show that if you try to time a vintage, that's a fool's errand, and you should invest consistently across vintages in this particular asset class. The data is explicit on that point. I do think that there are different groups of LPs. There are some that are much more sophisticated than others. Anecdotally, I do think that there is a lot of inherent either misunderstanding or frustration. You know, I spoke to a family office last week, and they explained that they started investing in venture capital funds in 2020, which, to be fair, not a great vintage to start. But they decided that, you know, through 2025, after 5 years of investing in venture funds, they haven't seen enough DPI, and so they're no longer investing in venture funds. And it's a statement that just doesn't, you know, they probably shouldn't have invested in venture in the first place. I do think, though, that whether they're sophisticated or not, it is fair to say, and this also goes back to Max's point, that LPs have a right to be frustrated, right? I think that within venture funds, they don't necessarily get a lot of transparency into what's really happening behind closed doors, right? Who's actually sourcing the right deals, how they got into certain deals, how they were priced, the decisions that are getting made, right? There isn't a lot of transparency that goes back to LPs. And so that can be frustrating and make it difficult for them to make reallocation decisions in funds. And I also will say this with self-awareness as someone who's been an early stage investor for 10 years. When you're an investor, you become great, or you hope you become great at picking founders, right? And especially early stage, that's a very human task. You don't get taught how to think about liquidity over time. And I was very fortunate to benefit over 10 years of seeing companies get acquired or go public and learning how to think about reserves. But unless you're deeply curious about those things, you won't learn them, because learning about that doesn't necessarily make you a great picker. And what that means is that when liquidity decisions are made by funds, do we sell a piece of our position? Do we sell an entire part of our position? Do we double down? Those decisions are often not made particularly intentionally. They can be made in hype cycles. And that is also very frustrating for LPs. So while I certainly agree with you that there are some, LPs that are not as sophisticated as others, I do think many of them have a right to be frustrated by the way the venture is being practiced today.
You're clearly right. I think it also, we can talk about LP sophistication. There's obviously also VC sophistication. If we talk a bit about be practical here, or give a bit of advice on how to manage through it, because you've both been through it, Juliet. I know you have a lot of thinking on this as well. I think one of the practices, of course, communication. You can talk about that forever and so on. I think that there's a governance perspective that a lot of VCs maybe don't take as much to heart as they could, which is really making sure that they put together an LPAC of sophisticated LPs that they actually trust, that have seen cycles, and that they can then spar with, and not just having it as a body that overlooks that everything is being done correctly, but actually being thoughtful people that you can go to and say, we're thinking about this stake. What do you think is right to do in this market? What have you seen before? And I speak to many emerging managers that it feels like they don't have that type of trusted LP relationship.
I mean, I think just quickly, I'm sure Juliet has some great thoughts on this. One of the challenges that I think is baked into this in Europe is it was a kind of cottage industry until the early 2010s, right? There's just, in terms of the density of people, and especially on the LP side, the density of LPs who've been in market for enough cycles, say 12, 15 years plus, to have seen how mobile, cloud, Web3, early AI, whatever, manifested the mistakes that were made and how people came out of it, is actually a relatively small amount of people on the European side. And I think, I don't know the data on it, but I would be really interested to know the number of more than 2 vintage old funds in Europe. There is, again, I would imagine it's a very, very strong power law towards first, second, maybe third vintage funds at most. And I think one of the challenges, we definitely found this in the conversation we were having with European LPs, is either, to Juliet's point, there's a kind of family office who've played around with it and are interested and might be easily spooked, or it's a pension fund, well, the pension funds are probably more sophisticated, but it's a corporate who's coming at it from the perspective of some innovation theater, or looking to kind of look for things that they can't find elsewhere. We definitely felt early on, admittedly, you're more naive and you haven't gone deeper on those networks. It's quite hard to find those people who have that level of expertise until you get to the Chicago endowments or the Stepstones or the more sophisticated, generally US-based fund of funds that have been in enough vintages to actually be able to help you think about how you manage through an IPO, how you manage through an exit. But I don't know, Juliet, what do you think?
It's an astute point, right? The ecosystem is certainly younger, and I would say quality over quantity, right? Whether it's an LPAC or it's informal, if it's harder to find institutional grade LPs that are necessarily going to help you think through that. And I do think there's some, but to your point, there are fewer than even individuals, right? And when you think about founders and they put together a cap table, they're crafting a group of folks that can each bring something different, right? A big fund that brings some star quality. As solo GP is going to be the first person they call, some angels who have some really specific advice for them. And I think the same can be true for fund managers, right? So even if you are crafting your pitch to make sure that it lands for folks who might be less sophisticated or might have seen fewer cycles or might have more questions than answers, you can also find some individuals, and maybe they are in the US and maybe they're elsewhere, who can be individual LPs or advisors to the fund that can sort of serve that role. So maybe it requires a bit more creativity. But frankly, even as you think about raising a fund, even before you even think about an LPAC, having those people around you is invaluable. I can't tell you how many mentors I have that I call constantly on a weekly basis, even just to think about how to handle specific conversations with individuals. LPs are so unique and they care about such different things. And so your pitch is going to be different in every conversation. And having people who've even just been through that on the VC side can completely change the difference between a meeting going extremely well or leaving 15 minutes early. So there are probably a lot of different ways to find that level of sophistication or interest. And I don't think it has to be necessarily from traditional LPs.
Can I ask the two of you a question? Because Max, you described your fundraise, the failed one, just before, and you had 13x MOICs in the founding team as angel track record and so on. Like you'd think that this is a no-brainer. Of course, you want to be on, and a lot of people in their 20s, when everything was up and to the right, that was how a lot of people invested in venture. I do think, however, that that's also how we end up with these bad situations of GPs that are managing other people's money that have never ever done that before and are honestly not as thoughtful as you need to be around your investment strategy, about around how you're going to liquidate, generate liquidity and so on. I'd love to ask the two of you to, like, do you think that there is a need for VCs to be more humble about the craft of venture? And I can obviously say one of the things we're trying to do with EUVC is trying to, of course, up-level the conversation, both in terms of what content is being created publicly, but also we're running our academy where we are taking people through like 14 sessions of fund modeling and portfolio modeling to figure out exactly what is this assumption, how does that impact another, like something 5 years down the road, and big discussion about Monte Carlo analyses, whether they make sense or not at all, and those types of things. And I don't think that most GPs can hold their ground in a deep conversation with a very sophisticated LP when it comes to these fundamentals of venture.
So my opinion might be a bit weird on this. I think it is kind of crazy that we expect people to become exceptional investors, right? Really train how to work with founders, how to identify and pick the best deals, how to win them, how to work with those teams, and also become exceptional at fund management, be really, thoughtful about compliance and risk and regulatory and legal and tax and fund admin and portfolio construction over time, whatever, and also learn how to fundraise and deal with LPs and investor relations. So I'm actually of the mind that while, yes, I think there are some very smart GPs who learn these things over time and are inherently curious and surround themselves with people who make sure they can make great decisions along them. I think this idea that we're looking for people to be excellent across disciplines is nonsensical in many ways. You would never go to a surgeon and say, okay, you're an exceptional surgeon. I also need you to be a world-class violinist, and I need you to be a philosopher or a mathematician or whatever. Like you would say, I need you to be a really great surgeon, and I really don't care about anything else if you're the one cutting open my head. So I actually think there's something fundamental happening in the ecosystem where we've put a lot of roles on one person. And so we're thinking a lot about how do you create systems or teams or platforms that allow investors to be exceptional at the thing they're great at and then get the support that they need to make those better liquidity decisions, to think thoughtfully about their fund model, to do all of the stuff that any LP should expect and wants to expect without having to, be an octopus and having every arm be as strong as the next.
Yeah, I actually completely agree with that. I was just thinking about like writing down some stuff as you were saying that. And I think there's two angles I'd come at it from. One is, I think one of the worst things that happened to venture was that it became high status. And what I mean by that is, I think if you ask most people in the 2000s, it was not a particularly sexy industry. No one really knew what it was. And I think there would have probably been less underestimation of the requirements of going into it. Whereas when something becomes high status, it's like where naturally, I don't know, the person who might have gone to Goldman in the noughties or an ad agency in the 90s or whatever it was, is like, oh yeah, I'm smart. I can do loads of stuff. I'll go do that. It doesn't look that hard. You're finding startups, you're giving them money, you wait for them to give you money back. And to Juliet's point, you then realize when you're in it that it's 3.5 jobs at the same time. And even just the fact that someone said to me the other day, there's such a thing as like a full stack investor, which is someone who has that skill set of managing LPs, managing regulation, being able to portfolio manage as well as just investing versus, I suppose, what you just call an investor kind of tells it. But I think there's also then a structural thing in the job, which I definitely only could learn by doing, which is someone described venture to me the other day in a really lovely way, which is like it's like being on a swim team. It's an individual sport that's done in groups, but you are fundamentally swimming your own race at any given point. It might be also that the other guys swimming on your team are important, but you're not swimming at the same time and you're not swimming the same race, really. If you think about then how that trickles down into the way that you learn the job, you learn the craft as you're doing it, versus, for example, other financial asset classes, like if you went and worked in a hedge fund or you went and worked in a large investment bank, there's much less preparation and training because the teams are so small and it is an individual sport. But also in all of those other asset classes, you have investor relations, you have back office, you have regulatory compliance because you have AUMs or fund structures that allow for the investor to just do the investment thing. So I always kind of joke that venture feels like finance for people who don't understand finance. But the problem is at the same time, we're being asked to then run a financial institution at the same time as doing a job that is basically picking like character archetypes and trying to find unique, exceptional people at the same time as working out regulatory compliance documentation. So yeah, I think it can be in some ways a bit of a poison chalice in that sense.
To me, the way I think about it is that you got to know what type of beast you are. If you're a solo GP, that gives you certain things that you got to excel at. And if you're also running, like in most cases, if you want to be a solo GP, you need to obviously also be able to do all the admin, all the fundraising, all that stuff. In that scenario, most often we see also solo GPs running what you might call a simpler investment strategy, which is a co-investment strategy where you're not spending hours and hours helping founders through the grind. You are supporting with an easier support. I know, Juliet, you have views here, but let me finish my train of thought here. I think there's a reason why most solo GPs will excel the most and do excel the most in running strategies where they don't need to lead the round, they don't need to price the round, they don't need to have a concentrated portfolio where they have to be thinking a ton about what they're doing with reserves and how they're managing through that whole journey, because they're just running one ticket in, I'll support you when you need me, I'm on to the next thing. Like, I know a lot of solo GPs would not like me framing it like that. I think if we're honest, many solo GPs run that strategy. That is what I think most can do if they run a solo GP strategy. Some are complete crazy guys. I know some, you know some, that can do the whole Monty. And I love them and it's incredible. But for most, that's the strategy. I think the problem is that we're seeing 3-person teams that are raising 70 or 50 that are running quite concentrated strategies with reserves of 40% and whatnot. And this is where you need to be quite thoughtful about the financial aspect. You cannot get away with saying, no, I'm just a hipster guy. I'm putting some tickets in, and then I'll help company building, and that's it. That is my view. You need to know the craft of venture in that scenario. Juliet, you're building something new. A lot in our audience.
Can I respond to those things first?
And I think you're doing an incredible job, and I think what you're doing is incredibly important because you'll unleash a ton of venture talent. I think it's incredible.
Thank you. I so appreciate it. I will say, though, I think there's some nuance to what you shared, which is one of the reasons that most of the solo GPs have the strategies where they do follow checks is a reflection of fund size, right? If you have a $20 million fund, you can't lead a bunch of $5 on $25 million rounds. So I think that's actually a big piece of it. I'd also argue that the market has become very competitive. And so if you think, that's no big deal, I can do 6 jobs because I'm just writing 250K checks. Yeah, the amount of the capital available to get a 250K or 400K or 750K check into a really exceptional and probably oversubscribed deal is actually very hard. And it means that any investor, whether you're a solo GP or a fund, has to spend a lot of time, making sure these founders do all the reference calls with all your favorite founders so they tell them how brilliant you are and trying to create a lot of value. And frankly, I would think even after making the investment, I know a lot of founders who lean way more on their solo GPs than they do on their funds because they feel more comfortable, they feel more aligned, and they don't feel like they have to be as performative. And so I would actually argue that the craft itself is still quite difficult, and a co-investing strategy can be hard to deploy. And that makes it even more important that You have the time to devote to actually working with founders and deploying that capital as opposed to doing all the other things. I do agree with you, right? Though, that the larger the fund or the more partners you have, right? Anything that becomes more complex requires a more complex solution. That's complexity theory at its heart. And it's been shown, right, that partnerships of venture firms deal with a lot more complexity, especially making investment decisions in a group is a lot harder than making them as an individual human being, and relationships that haven't worked together. So I couldn't agree with you more in terms of, right, there is a even greater need to deeply understand how the actual business works as funds get larger and partnerships get larger. But I certainly wouldn't discount the amount of effort it takes to deploy a fund as a solo GP and how distracting the rest of the work can be from doing an excellent job, not just doing the job, doing it really well.
Juliet, this might tee you up for something else, but I'm going to get my tiny violin out for solo GPs at this point. But I do sometimes look at the 2 and 20 model, especially on the bottom end, and just it often blows my mind how bad the economics are when you're below a kind of 20 million fund, right? Just in terms of how you're supposed to, with a 400K a year management fee, have more than a one-person team and legal overheads and legal expenditure on deals and an office and travel and all of these things. And then I don't know how much you want to talk about what you're up to at the moment, but do either of you have a strong view on whether you feel like that 2 and 20 model is the right way to be thinking about things? Because like it works, it skews way too good once you get above a kind of 500 million fund, right? But on the small end, which I completely agree with you, is where I would argue a lot of the most interesting work in the industry is done, and a lot of the people work the hardest, are the most founder friendly, are the most honorable form of the job that we do. The economics are terrible.
So I've seen a lot of solo GP funds now doing 2.5 and 20 for that very reason. And I've actually seen LPs totally understand it. I think most of LPs' frustration with fees has a lot to do when funds get really enormous and suddenly
Totally
$100 million. And especially when you think of the pass-through fees and all sorts of stuff. So I think for smaller funds, I've actually seen LPs be relatively comfortable with that. And I think there are also things you can do around blended fees, right? You may have a 2% blended fee over 10 years, but for the first few years, it's 2.5 or 3, and then it goes down over time. And of course, if you think about raising subsequent funds every 3 years, perhaps, then having the additional fees from the extra funds allows you to sort of maintain what it is that you're building operationally. So I think there are creative ways around it. But I think it's an obvious thing to say, yeah, solo GPs are not going to make money on cash. They're doing it for the carry. And I think that's a beautiful, beautiful thing. The real question becomes, if you don't have a lot of savings, or if you don't have a wealthy family member and you have kids or a mortgage or what have you, and you're in this time, there are a lot of people who financially cannot be without a salary for 2 years while they go fundraise, put up, every dollar they've ever saved into GP commit, $150K to get the thing set up. That in itself can be a huge barrier. And I like to think that someone's ability to be a great investor has nothing to do with the wealth that they have by a certain age. So that's a separate set of questions.
The court poet of the 17th century and in the 21st century, you're patronized by wealthy families to bring them interesting things on a monthly basis.
There are so many things in life where, like, we've ended up with a system. It's the system that everyone knows and understands and have agreed on. And it's very, very hard to unlock. As you say, Juliet, the way that most people are allowed to kind of solve for it is by blending fees so that they get a bit more upfront. Most LPs will be okay with that. And then the fact of the matter is just that being a solo GP is incredibly hard. And as you said before, Max, for some reason it's become incredibly high status to be a VC. But the fact of the matter is that the 2-year grind that you're doing in the beginning to get off the ground is definitely not high status in any way. I want to ask the two of you, and I don't think we should go into this conversation too much, and that is the fact that software doesn't really need venture the way it has used to. At least many start to argue that. We're seeing that some argue that it's no longer a matter of are you able to build, now it's only a matter of are you able to build moats and continue executing faster than everyone else and so on. And that is all changing how companies are built. I think it's hard to go too deep into that, but I'd love to ask the two of you and rather say, okay, we all know, I think everyone tuning in here, know that there's a lot going on in the market right now. The question is, where do you see the market moving for venture funds?
You made the perhaps naive claim a couple of months ago that I think that within probably 5 to 10 years, I think the industry will be 30 to 50% smaller in terms of number of funds. but probably similar or even bigger in terms of AUM. And we're just seeing the kind of ultimate barbelling of huge platforms that can market make and are kind of almost quasi organs of government in some of the US senses. And then this long tail of smaller, nimble, expertise driven, very taste driven solo GPs. How you then overlay that onto the barriers to entry of building software companies. I mean, someone said it yesterday in a group chat that Juliet and I are in, that if you're not in a regulated industry or you're not dealing with kind of proprietary real world data at this point, have we got to the point where like software is already tending towards zero? Like the defensibility of software is tending towards zero very rapidly. And I do see that. I'm seeing a lot of VCs like panicking around the idea of doing any kind of software unless it is dealing with critical minerals or in like deep financial services or in health tech or whatever it is. My personal view is I think we will end up with a lot of founders who are already going down this train, maybe raising like minimum viable venture or seed strapping a first round or a second round and then never needing to raise again. But that the norm that we've seen in the kind of ZERP 2010s into 2020s era of every tech company needs to be a unicorn will, I think, start falling away, and that people will get more comfortable again with the lower defensibility, lower barriers to entry, easier to build. You can rapidly spin up something that can generate, I don't know, 5, 10, 15 million in revenue. You try and turn that into something profitable, sustainable, you flip it to someone bigger, or you acknowledge that it just has a shorter lifespan, and that we will still have Salesforce and OpenAI and Anthropic and whatever it is. But I do think that a lot of software that we used to think look like venture type products will go back to being what I would consider to be more like SMBs, like just kind of classic companies that if everyone can spin up a startup, they'll just start looking more like owning a corner shop or having a dry cleaners or whatever it is. And it will just be a different type of business that happens to be software driven.
I love that analogy. I hadn't thought of it that way. I have a couple of thoughts on this. One of them is, so if there's still a lot of money in the ecosystem and there's a lot of exceptional talent that's able to raise that money, but they don't need to spend as much of it on software engineering talent, say, what will people spend the money on? What will we get that might be different? It's very common that, for example, startups at the very beginning, it's founder-led sales. That's all you see. What if you can invest in go-to-market or run more experiments or frankly, pretend like you have more gravitas and more weight earlier on than you do because you don't have to spend the money necessarily on that talent? I'm curious. I don't know what that answer is. My gut, though, tells me that hiring exceptional talent remains the number one question on every founder's mind. And that includes engineering talent, people who are really thoughtful about architectural decisions and design and how to leverage data most effectively. And so instead of, okay, we don't need to hire as many engineers, so people aren't going to raise as much money, I do wonder if it's, okay, maybe if we hire the same number, the output is even greater, or the outcome is even greater. I think the levers could actually look very different. So this is all to say, we can all guess, but the reality is great people are still going to start companies. Investors are still going to try to pile money into them. So the value that's created and what they do with it that's really up for grabs.
The way I think about it, Max, is we're seeing a lot happening in the input end, meaning in the investing side. It's very, very hard to figure out where should I put my money. And because companies are completely being rebuilt, the modes are different, all this stuff. I don't think, however, that there's necessarily that much happened on the far end, which is the outcome end, because what is really driving big venture outcomes is whether we have network effects, whether the market tends to accrue to one big player, or we will have it across a bunch of different smaller outcomes. And I don't really see that side of the company building phase be different. I actually see AI as more as a centralizing factor than maybe a decentralizing factor. And for that reason, I don't necessarily think that the venture scale outcomes will be fewer and smaller. I actually think that it probably will remain similar, but the journey to get there will be very different.
Both of your guesses are perfectly fair, right? But I think this is kind of the beauty of the industry, is that for various funds, you can have a different strategy. The key is, are you a good enough listener as the market starts to move in a particular direction to be thoughtful about it and shift? We saw a lot of people who were not very good at doing that in 2021, right? And so in these moments, are people able to keep their head on their shoulders and listen and watch, or are people going to make a lot of really jerking decisions?
We're actually, Max, it's funny because what you do describe, however, I completely agree with. I don't think it necessarily changes venture, but I think that it will give birth to a new asset class, which is AI roll-ups or roll-ups in general, search funds in other words, that you build some technology that can very easily be deployed against or over a ton of smaller existing shops because you can run it with a smaller staff. And then that's typically then a rollout strategy where you're acquiring a ton of accounting firms or something like that.
It's
based
already,
on
yeah.
It's already happening. We're doing a dedicated podcast to that space because we're seeing that it's moving so fast. We have in a couple of weeks a new team coming from venture, building a strategy purely to do these types of investments. And I think that will definitely become a new type of player in the market, so to say. And I think that that's where the part of normal SMBs that have not been affected by software so far, because the market dynamics have been so that it makes more sense to have it be local, smaller players. I think that is up for a change now.
The way I think about that is it also just goes back to the age of the asset class again, that it is still a relatively young asset. It's the joke I always like is when you're a venture hammer, everything looks like a nail, right? And it's like, so we've just applied this like quite blunt funding mechanism to 100 different types, shapes, sizes of business. And actually it's very rarely the perfect one. It could be a combination of debt equity. It could be asset-based financing. It could be bridging the FOAC gap with some kind of leasing model, whatever it is. And I think what we're seeing now, probably driven by the fact that also like top end venture like software returns have started looking fewer and further between, is people going, oh, actually, like this turns out this doesn't work for everything. We do need these various different funding models. I suppose the interesting question on that is all of those funding models are solving a problem that exists today. And like I was sitting with a friend yesterday who's just taken a job at Anthropic because he was working at an infrastructure startup, and Claude Code, the most recent version, came out and he realized it could do his job better than him. This is like a senior engineer. And he basically was like, this company isn't going to need to exist in 24 months. The only leverage I have here is to probably try and go and work for the people who are going to make me redundant. Fair play to him, he got the job. But I think in that context, I suppose the vector that we're not thinking about it on is, yes, all of these interesting models are being formed for a world that exists today. If you draw the line back to 2022, when like GPT could barely solve kind of degree level maths problems, and now you look at what Claude Code's capable of, if you drag those cells out and the curve continues on the same trajectory, a lot of the questions we're asking today will feel very naive around how the asset class should be structured in 24, 32, however many months.
We only have 5 minutes left, and I want to ask you one thing because we went over it a little too quickly, I think, and it's the big question that I think a lot in European venture are sitting with, and that is, of course, when we're all talking about barbelling, massive platforms on one end, small specialists on the other end, and then everyone kind of says, and then the middle will struggle. But I'm looking at two here. You're both associated with Kindred. Kindred is, you could argue, in the middle of that. Like, it's not a small firm. It's not a huge firm either. And we have a ton in that space. My view, and the reason why I dare say that I would put Kindred in this middle point is because I don't think that it's true that the firms in the middle are going to suffer as much as we think. I think we will have a ton that will suffer, but I think it's for lack of quality. And I think that there are firms like Kindred that are obviously incredible performers and a great firm. And whether they go big or they go even smaller, doesn't matter. Like 250 is a perfectly fine place to be.
We can argue where that line is. I think it's a bit bigger than where Kindred is, but it's
great.
Sort of besides the point. I think the point that is important, though, and why this conversation is happening is it is a competitive market, and there are people who are not price sensitive and can win simply by saying, we'll give you more money and dilute you less, right? And a lot of founders will say, well, that's a better deal than the alternative. And so what's been incredibly important is for venture firms and their partnerships to be able to articulate more for founders than and obviously for themselves and LPs, but most importantly for founders, why working with them gives them a greater chance of success than working with someone else, even if the underlying economics don't look as juicy, for example. And I think Kindred, I'm obviously biased, has done a particularly excellent job of being able to articulate that to founders. And founders have chosen to work with them oftentimes either alongside or instead of some of those platforms at the early stage, because they recognize that if they work with partners like Kindred very early, then the likelihood they will get to Series A and Series B and Series C is a lot higher because of that kind of partnership, reputation, the ecosystem, the network, et cetera. And so I think it's probably, I do think there is a correlation to fund size in this particular round, because the bigger the fund, the larger the checks you have to deploy for the economics to work. And winning those rounds gets harder and harder as those check size go up. But regardless of that point, being able to articulate to founders why working with you is their best possible chance at success is the key. And a lot of funds that were generalist funds and got bigger have made it harder for themselves to be able to make that case when they are competing with a generalist fund that is 6 times their size.
You lose that ability to play on the small end when you get past the probably like 250 mark as an early stage fund. And so the size of ticket you're having to deploy, but also the fact that if you go for a distributed strategy, you're needing multiple, and you're only 5% exit, 4% exit, you're needing multiple 5 billion outcomes within one fund, which if you just look at the amount of multiple billion outcomes in Europe in the last decade is making you exceptionally good at the job to make the economics stack up. I think where we sit is probably on the top end of absolutely feasible in terms of size of outcome, but also a strategy that is highly concentrated. So if we are as good as we hope to be at the job, we have a small enough an amount of bets where we have a big enough stake in them that you only need 1 or 2 of them to come off, and they don't need to be, obviously we want them to be, but they don't need to be astronomically large. They need to be OpenAI sized outcomes to justify the fund. I think the really hard place is the 500 to 700 million Series A fund in Europe that's looking to basically have to index like probably 20-30% of the outcomes in a given period to hit those multiples. And to Juliet's point, is fighting against large US platforms who aren't price sensitive and have bigger brand, more resources, and then just can throw more at you very quickly.
Juliet, Max, thank you so much for joining me today. We could talk forever about this, and I'm sure the chat will continue on WhatsApp and anywhere we go. I hope everyone tuned in today enjoyed the conversation as much as we did. It was a bit of a feisty one. I enjoyed it. I hope you did too. Thank you both.